percent reducing balance. The first question was to calculate the written down allowance and hence the tax saving for each year if the proceed on disposal of the asset are $12,500. These first were collected, were found the answer. Today we are going to deal with this B, where they say if net trading income for the project is 16 per year and the cost of capital is 8, calculate the free cash flow and hence the net present value of the project. Here, as you see, the net trading incomes, this means the income this project is going to earn for each year. It is 16 in each year. We are going to write table which have time, year 1, year 2, year 3. For net trading income for year 1 it is 16, year 2 16, year 3 16. And then if it is a tax, we are going to charge a tax. After that we're gonna look about the post-tax operating. Here, as we see the answer in a B, where we look up for the net trading inflow, the income comes in, it was 16 as they say. Tax payable was 30%. We are going to charge tax each year. Then we subtract the tax from that info. We get 11 and 200 in each year, which is called post-tax operating flow. Then we raise an initial investment which is equal to 26,000. We're gonna to be subtract. Then we have to add on the scrap proceed, the value of the asset that remaining is 12,500. After that, that scrap proceed is where the amount of money they said that asset. And then we can add on the tax relief on work down allowance that we have found in answer 1, where we see the tax saving for year 1, year 2, year 3. Then we have to add on. After that, adding the tax relief on written down value, we get the free cash flow. After getting the free cash flow, we have to use that 8% as discounting factor, and then we get the present value for each year from year 0 to year 3. After that, we have to take a time from year 0, it is like total, and then we get net present value. So that is how this question was about. So today let us continue about the calculating free cash flow from accounting information. If you have accounting information, you have to calculate the free cash flow. You have net present value, you have accounting information, you have SPOL, statement of financial statement of profit and loss account, you have SFP, statement of financial position. You have to calculate the free cash flow. So far, we have been considering the use of free cash flow in investment appraisal. However, they are often calculated to appraise a company performance or as basis a share value. In this situation, the level of free cash flow is more usually determined from the already preparing accounting information and therefore is found by working back from the profit. So this table is showing us how it's work until you gain the free cash flow. Here, the first you get the net operating profit from SPOL. meaning you get the profit interest before you get the profit before interest and tax. This means that it's for future years. Expected profit are predicted based on expected growth rate. After getting this, you have to add the depreciation. This depreciation, it is not cash flow, and therefore added back to the profit. For this depreciation, it is like that writing value, down value that you get. After that, you have to raise the tax if it is available, and then you get operating cash flow. After getting operating cash flow, you have to raise an investment if available. Then you have to raise replacement in an current asset investment. You have replacement in assets. You have to raise that value. So after that, you have to raise an increment on an assets and investment. If you have an incremental, suppose you have purchased another investment, that means that is an increment that have been increased. So another things you have to raise the incremental working capital investment. If there is an additional investment, you add on an investment, you have to add an incremental, as you have found in the previous I think it is in day 2 where we look about an exercise where we are collecting working capital increasing where they were an impression. So this is what you're gonna to raise. After that, you get the free cash flow. This method gives the level of free cash flow to the firm as well. When you calculate over a number of years, an investor may draw a conclusion from emerging trends. So, increasing the free cash flow often an indicator that increasing earning are to follow, meaning that if the free cash flow increase, they indicate that the earnings are increasing. If there is a decrease in the free cash flow, they also increase the indicators of the problem which will be ahead. Free cash flow to equity. The above approach calculated free cash flows before deducting either interest or dividend payment. Uh, the free cash flow to equity only can be calculated by taking the free cash flow calculated above, and then you deduct the debts interest paid, and also you deduct any debt payments, and then you add any cash raised from debt issue. The free cash flows to equity provide an alternatives. Agree more meaningful figure that earning is in the calculation of dividend cover, meaning the dividend cover in cash terms equal to the free cash flow to the equity, then you divide by the dividend paid. So thank you for today. Tomorrow session where we will discuss about this an exercise where we are going to correct this question that is from accounting information. So thank you for today. My God bless you, and remember to subscribe in order to get the more video about the exercise calculation and different things.